Hello everyone, welcome to Thai Finance. Today we're going to talk about cost of goods sold, or COGS. Today we're going to talk about the different names cost of goods sold is called by the financial community, or the different financial statements that you will find. We're going to talk about the formula and the definition. I will tell you how it's related to sales, profit, and the different financial statements, as well how inventory and labor costs impact the cost of goods sold, and what to do if you are a service provider. So if you think this is interesting, you should definitely watch this video. So let's start with the different names that cost of goods sold has. First, we can find it as COGS as well, of cost of goods sold. Then we have cost of sales, and the final is the cost of services. And you can find it in the income statement in these different ways, but it depends on what the core business of the company is. If it's a service provider, you will find it as cost of service, and if it's different, retail or merchandising, manufacturing, you will have to check it out. What's the core business to understand the financial statement, of course. Then what is cost of goods sold in reality? I will put it very straightforward. It's what it costs you to produce the things you're selling based on your sales or revenue. And what is revenue? The money brought in by selling products or the services. And here is the formula that you can find on the income statement. It's revenues minus cost of goods sold. First, let's stop at cost of goods sold. Costs of goods sold is the costs that are directly related to producing your products or services, and it includes labor costs. So basically it's just the cost of production, and of course within a period of time. It could be a month, weekly, or yearly. Normally it's within a year. And then we have the gross margin. And what is gross? Gross mean in German is just something big, but at the end it's gross margin because we have not taken out all the other expenses while doing business, like our phone or electricity bill, or imagine just water or advertising. Then what financial statements have to do with cost of goods sold? So first we have the profit and loss statement, and here you can find the COGS, of course. And then you have the balance sheet, and well, you don't see the COGS, but it's very related to it because you have inventory. And what inventory has to do with the cost of goods sold? So let's check it out. So why inventory is key in cost of goods sold? So here we have again our first three top lines. Then let's make it a little bit bigger for you to just figure it out and break down things as we go. So cost of goods sold, you obtaining basically by calculating three different things, which is your beginning inventory. Then you have the purchases. This is the things you pay to suppliers to make your product, your cost of production, your inventory. And then you subtract your ending inventory after your sales, of course. There you have the cost of goods sold. This is basically the number that appears in the income statement. The profit and loss statement is just the same. And then what happens when you sell services and not products itself? It's just you're a service provider. Well, COGS is normally called cost of sales or cost of services, and it doesn't include inventory. It includes billable hours of service dedicated to clients, and this of course must be tracked. So you have to have or to get a track management tool. Administrative and general tasks, they just go to expenses. This is everything after gross margin, remember? Like electricity or water, so something to consider. Labor costs and inventory are tied up in the balance sheet until the cost is recognized in the income statement. For this, the goods or services need to be sold first. Let's analyze a little bit the COGS. What can we get from this number? If you see an income statement, of course you can look at the gross margin. And the gross margin tells us how profitable the company's operations are. This means how did the cost of goods sold perform. And of course, higher margins are more desirable. And then we have the COGS. What can affect this number? First, the suppliers. If you are buying always at an expensive price to your suppliers and you are having high cost of labor, you'll get less margin, of course. And then innovation. This is why all the companies want to invest in innovation, because it decreases the cost of goods sold. And it could be from the inside operations to good supply chain management. And it's basically a big competitive advantage. That's why innovation is key here. And then, of course, we have the revenue. You can have higher margins if you increase your prices, but at the end, you will not be as competitive. So it's better to have lower cost of goods sold than higher prices, because you have more advantage versus your competitors. Please subscribe to the channel. I hope you enjoyed this video and learned a lot. And please check the channel so you can see a lot of more tools for financial analysis and world economy and everything related to management and business. Thank you very much.